The slowing Chinese economy very much in focus since the start of the year. Hong Kong led losses in Asia-Pacific markets today as investors try to deal with the fallout from the liquidation order for property giant Evergrande. Our next guest has exclusive new data on China's economy. He says it's critical that authorities put a floor under the property market. Let's bring in China Beige Book CEO Leland Miller. Leland, it's great to have you. The Wall Street Journal today pointing out 20-year lows in Chinese 10-year government bonds. What does that tell us about the state of the economic growth story in China and what might have to happen from the authorities to try and restart it?
Well, the story is that there's just very little confidence in China right now. There's not confidence in corporates. There's not confidence with consumers. So the question is, how little can the Chinese government get away with in terms of policy support to keep people in the game, to avoid some sort of doom loop in the stock market and the property market in terms of consumption, but also not reverse course from the last 3 years of painful medicine they've served up in terms of property deleveraging. So, I think what's disappointing markets is that things have been bad, but they haven't been bad enough for big stimulus, and that's a great frustration.
A lot of it is what we hear coming out of the country about stimulus efforts, even small around the edges type measures like, trying to clamp down on short selling and find an excuse for the Chinese stock market to catch a bid. It feels very familiar. It feels like a previous playbook. What do you think specifically ought to be done now, if anything? I mean, unless you just have to let the market kind of sort it out.
Well, I know I'm going to get a lot of tomatoes thrown at me for this, but I would say they're doing mostly the right thing. There's an expectation by people who are playing the market that they're going to get the Chinese government at their back, and then they're going to be able to hit the big bounce, and they're going to get big stimulus, and then things are going to go back, and everyone's going to be smiling. This is not what Xi Jinping wants to do with his economy. They moved away 3-4 years ago from the current economic growth model. They don't care about high levels of growth. They don't have the same stimulus playbook. What they'd like to do is set a floor on growth. They don't want a disaster to happen, but they also have their priorities set far away from the idea of just growing fast. What they want to do is make sure there's not a doom loop of confidence, just enough stimulus policy support in order to keep things going, keep things chugging forward, but not enough to juice investor returns, not enough to juice the stock market, not enough to send growth skyward.
And what about, those measures, if it's just enough, as you characterize it, should apply to the property market? I mean, how do you restart confidence when there's been a recognition that, the whole sector was sort of operating in a bit of a false economy for a long period of time, based on expectations of, being able to speculate in housing and based on a lot of government incentives, to essentially do so?
Well, the little secret that no one wants to say out loud is you can't. You cannot get confidence back in the Chinese property market because they don't really want to do that. They want to set a floor. They don't want a disaster to happen. But they've spent the last several years deleveraging the property sector. They want it to go from 25% of the economy and as a major growth driver to something far, far less and far, far reliant on endless streams of credit. As a result, what you have to do is you have to have your hands off. You have to let the weak firms fail. You have to allow for the market to slow down. You have to allow for prices to slow and sometimes contract. What does that do? That scares people a lot. So they don't want something bad to come of this, but they also don't want to restore confidence enough to return to the status quo ante. So this is a very difficult policy challenge because they're going to have to do just enough to make sure people aren't panicking, but not enough to really let the market recover because that's not what they want to happen.
It wasn't terribly long ago that the storyline was, this was an economy that was turning more toward domestic consumption, and it was more of a consumer-led and maybe income growth-led story. I mean, you obviously have population, declines in some respects and aging of the population. So is that not the case anymore, that it's just going to kind of be a little more of a self-contained type economy?
Yeah, that was never the case. That was a bunch of nonsense that was being fed to us by people who had a vested interest in having flows directed into China. They were making money off the story, so they were telling the story. China's never been a consumption story, never been a domestic consumption story. There's never been the rise of the Chinese consumer because structurally speaking, the economy suppresses consumption. It suppresses household savings. So you're never going to have an explosion of consumption in China because structurally it won't allow it. So it was a great story, made a lot of people a lot of money. It was never true. And so now we have to be a little bit more realistic with our portfolios.
It's interesting. I do keep an eye on a lot of commentary among investors, domestic investors in the U.S. here, who would try to make the case that, wow, sentiment toward China, the Chinese market, the Chinese economy, seems like it's washed out. Nobody expects anything of it. They feel like they can safely ignore it if you have a global investment portfolio. And then you talk about how China itself doesn't really want overseas investment flows. So, how do you square those two things? Is it possible that it could be an undervalued market and underappreciated at the same time that the Chinese authorities aren't really doing much to try and make it a shiny growth story again?
It depends what kind of investor you are. If you're a sophisticated investor who trades on volatility and really knows what they're doing in terms of the China story, you can make money in China. It's not uninvestable from that perspective. But the old way of investing in China was to sink your money in, check it every 3-6 months, cash the dividends with the expectation that China had sort of drawn a moat around its tech champions and other national champions. And you could just, cash your dividends and smile at the quarterly meetings. That story is over. It's not impossible to trade China right now, but you can't trade it like you used to because there's just too much going on. And too much of the sentiment is based around the idea that there's going to be some sort of, rocket ship of stimulus that's going to save everybody. That is not going to happen. And no matter how many times and how many years we tell people, they still try to trade on it.